Hi, everyone. We're working our way down the balance sheet, and it's time for us to consider another current asset, accounts receivable. Now, let's start out by understanding that in the early portion of the course, we tended to put in the accounts receivable account anything that was receivable, whether that was from a customer or from the sale of machinery or a variety of other sources. In truth, the accounts receivable account should be used only for obligations of customers or clients. We don't want to put collectibles, receivables from the sale of land, if we're not in the business to sell land, or loans to employees. Those kinds of things should not find their way into the accounts receivable account. And the reason for that is going to be that financial analysts and financial statement users will use the accounts receivable information that we report, and they're going to calculate some ratios. A receivables turnover ratio, for example, net sales divided by the accounts receivable balance, or an average collection period statistic can be calculated, which is accounts receivable divided by average daily sales. The latter ratio is simple to calculate and very, very useful. If you know that the standard terms that people in your industry give their clients is 30 days for them to pay, and the average collection period for your business is 110 days, that recognizes we see a problem, okay? So what we're going to wind up doing is making sure that we don't confuse the financial statement reader by throwing other kinds of receivables into the accounts receivable account, just those from customers or clients. If 30 days are the standard terms in your industry, you'd much prefer to see this number, this average collection period, somewhere between 25 and 35 days. And if you throw in receivable from the sale of land, for example, you might really dramatically change this number and truly confound the financial statement user. So now we know what goes into the accounts receivable account. We've said just about everything that we need say about receivables. The problem in accounting for accounts receivable is the measurement of uncollectible accounts. Now, why do you ever allow someone to leave your business with your goods and not having paid for them? The answer typically is we believe that extending credit to our clients increases our sales and therefore our profits. As a consequence, we have to recognize that often some people, some of our clients or customers won't pay us, and that cost, that bad debt expense, is just a normal business cost of doing credit business. Now, when you think about it that way, it gets to be easy to think about this in terms of simply an expense and the general accounting principles that apply as we think about recording expenses. Now, there are two methods that we can use to calculate bad debts expense. The first of these is called the direct write-off method. The direct write-off method recognizes the loss associated with the uncollectible account at the time the account is identified as uncollectible. The second method we'll characterize as the allowance method. And the allowance method recognizes a loss at the end of each accounting period as an adjusting journal entry. So it's an estimation at the end of each accounting period. Let's take a look at these two methods. The first, the direct write-off method, would recognize the bad debt expense only when it becomes apparent we aren't going to be paid. The second time your bill comes back addressee unknown, that's a hint that you may have a lot of difficulty collecting this one. So the accounting entry that you would make at the time that you actually made the sale in year one would be this one, debiting accounts receivable and crediting sales. And in year two, under the direct write-off method, when we have a bad debt and we identify this $50 sale is not going to be collected, then we debit bad debts expense and we credit accounts receivable. Now, the difficulties associated with the direct write-off method are these. First, it's incredibly simple. That's good. We like simplicity. And we know that it's accurate because at that moment in time, we now have evidence that this $50 isn't collectible. But we also know that the likelihood is that we're going to mismatch revenues and expenses. In the particular example I just used, we have revenue in year one and we have expenses in year two. So expenses that are attributable to the earnings process that went on in year one are not going to be matched with the earnings in that year. The result will be that we're going to overstate accounts receivable on the balance sheet to the extent of anticipated bad debts, and it's clear that we've mismatched revenues and expenses, so the income statement isn't particularly useful. It's been damaged. The result, unfortunately, is that this simple method that is very accurate can't be used in accord with generally accepted accounting principles in the United States, can't be used under IFRS either. Now, you may still find it for unaudited financial statements where we don't purport to present financial statements that are in accord with generally accepted accounting principles. And of course, where they are immaterial, where the bad debt number is so small that nobody really cares because we don't do much credit activity, for example, then you can probably get away with using the method. Otherwise, though, you should not expect to see the direct write-off method being used. The allowance method will measure bad debt expense at the end of the accounting period as an estimate. So we're going to create a contra asset account for the balance sheet valuation of accounts receivable. We're going to debit bad debts expense and credit the allowance for bad debts or doubtful accounts more often for the amount that's appropriate under the circumstances. Okay? So we're going to make an adjusting entry. Now, please note that in this adjusting process is the only time that we debit bad debts expense. We don't charge a bad debt expense account with bad debts any other time during the year. We make this estimate using the data that we're about to talk about, and we make this adjusting entry, and that's the only time bad debts expense is debited. Now, you know that shortly after we make this adjusting entry, the bad debts expense account's actually going to be closed out. This account, though, our contra asset account, will be a balance sheet account. And as a consequence, it will live on. And on our balance sheet, we're going to report accounts receivable less the allowance for doubtful accounts. This could be $15,000. This could be $1,000. And so the net value of accounts receivable in that instance would be $14,000. This contra asset account, the allowance for doubtful accounts, is the one that we've just created and will be used to give us a good valuation for accounts receivable, the best we can estimate. Okay. When I actually write off a bad debt, I finally recognize that I've got a bad debt. Then we're going to debit the allowance for doubtful accounts account, and we're going to credit accounts receivable, and we're going to adjust a subsidiary record. So if you look at the allowance account, we're going to credit the allowance account for our estimate at year end. And we're going to debit the allowance account for our actual experience, the actual write-offs. And at the end of the year, if we have a debit balance left in the account, then we will know that we overestimated our bad debt experience. And if we have a debit balance in the account, then we know that we underestimated our actual bad debt experience. So this becomes nothing more than an estimation error. And you'd expect them. You don't expect to get this exactly right. Okay? So debit bad debts expense only under the circumstances that you're making that estimating adjusting entry. The rest of the year, this is the kind of entry that you'd expect to see as we write off our actual bad debts. Now, using the allowance method, a number of obvious issues arise. How do we estimate bad debts? What data do we consider? What exactly are we estimating? Are we focusing on producing the best income statement that we can, and therefore we're focusing on coming up with the best bad debt expense number that we can? Or is it more important for us that we have a good balance sheet? And so is the point of our focus those accounts receivable that are not collectible? It turns out it may make a difference in the way we think about it and the way we calculate the amount of our bad debt expense in addition to the allowance account in the adjusting entry. And then what should we do with the estimation error that usually results? So, the data that we would normally use to estimate bad debts would be industry norms and our own personal experience. So if in this industry 2% of sales or 2% of accounts receivable turn out to be bad, then that helps us develop this statistic, this 2% of. Our own experience may indicate that our credit and collection policies are more stringent than the industry, and so maybe 2%, the industry norm, isn't as appropriate for us to consider as our own company experience. And then if there are changes in circumstances, if you're doing business in a new country and you realize that the legal structures that would support you in trying to collect a bad debt are weak, and as the outsider may not work to your advantage, maybe you want to modify your historical experience and the expectations of the industry by what you know may be additional problems. Okay, so that's how you do it. You develop a statistic using those data. And the statistic is typically a percentage of either net sales or a percentage of the accounts receivable balance. We would use net sales if we thought that the income statement was the most important of the two financial statements and that we wanted to know what part of this year's sales were not collectible. If we think the balance sheet is more important, then we use the accounts receivable balance as the basis for our calculation, because we want to value accounts receivable as best we possibly can. Now, if I use the income statement approach to this analysis, then the object of my estimation is going to be bad debts expense. Now, you and I both know that the credit to the allowance account is going to affect the balance sheet in the same dollar amount. But from our standpoint, what we want to do is we want to focus on that bad debts expense number. We want it to be the best it can be. And so we typically will estimate a percentage of net sales. And once we've made that calculation, then we're going to make this accounting entry. We're going to debit bad debts expense and credit the allowance for doubtful accounts account. And the amount that we're going to use in this entry is going to be the dollar amount of the estimate. the dollar amount of the estimate. Now, the income statement method assumes that the income statement is the most important statement, doesn't really give a lot of consideration directly to the balance sheet, and it provides no direct adjustment for prior period or periods estimation entries. So if you constantly estimate it a little low or a little high, then the result could be that the amount of the accounts will grow, that we will see the allowance account get smaller and smaller or larger and larger. And that may cause the valuation of accounts receivable in the balance sheet to grow materially unrealistic. If that error is consistent and grows and poses this problem, then we're going to have to make an adjusting entry to allow for reasonable balance sheet valuation as well. Now, if I use the balance sheet approach, if I go at this focusing more on the desired balance in the allowance account, because that's what we're going to be estimating. We want to know the size of that allowance account balance, which will allow us to value accounts receivable at the best number that we know how to produce. Then we're going to essentially use a percentage of the accounts receivable balance in this instance. Now, you know that the accounting entry is still going to be a debit to bad debts expense and a credit to the allowance account. Now, please note that if we use this method, something interesting happens. The existing balance in the allowance account, which you remember we said was prior period or periods estimation error, has to be considered to properly value the account. The result is that using this method, you actually get an automatic prior period error adjustment. But you can wind up with some pretty wide fluctuations in the amount of our debit to bad debt expense as a result. So let's see how this works. Using the income statement approach, if our net sales are $566,500 and our bad debt estimate is about 2% of net sales, then 566.5 multiplied by 2% tells us that $11,330 should be the debit to bad debts expense and the credit to the allowance account. So this one's really very straightforward. You make your estimate using the income statement method, and that's the dollar amount of the debit and the credit. And now let's look at the balance sheet approach. If the accounts receivable balance is $328,000 in this example, and the allowance account already has a $15,000 credit balance, then we know that in the last accounting period, we know that we overestimated our bad debt experience. If our estimate tells us that 6% of accounts receivable will not be collectible, then 6% of $328,000 tells us that the desired balance in the allowance account will be $19,680. That's what we want to finish the year with. So what do I have to put in the account to generate a $19,680 balance? I only need to put $4,680 in the account. So in this instance, the entry we make this year corrects for last year's prior period's adjustment and gives us, we believe, the best balance sheet that we can get. The balance sheet is going to read accounts receivable of $328 less the allowance account balance, and that's going to be $19,680. And that, we believe, will allow us to calculate our accounts receivable at their net realizable value. And the rule is that we want, from a balance sheet perspective, to report our accounts receivable in the amount we expect to collect. Now remember, accounts receivable are current assets, and they're designed to give us a measure, definitionally, of the amount of resources that are available to pay off current liabilities. And to that extent, the amount that we don't believe we'll be able to collect, the $19,680, should be subtracted from accounts receivable to yield the balance that we do believe can be collected, that balance that will be used to compare with current liabilities in the current ratio, right? Okay, so the balance sheet method automatically corrects for the prior period's error. And that's really good for the balance sheet. Notice what it does to the income statement, though. Last year, we had $15,000 left in the account, so my presumption would be that last year we may have had $25,000 or $30,000 or even more as bad debt expense. That was the estimate. This year, we're only going to have $4,680 because of our overestimate. Now that means a lot of volatility in the measurement of bad debt expense from one period to another period. We think in that process that the quality of the income statement may have been impacted. The majority of businesses that are publicly traded in the United States will use the income statement approach rather than the balance sheet approach as a result. Okay, so the income statement method gives us a balance sheet valuation of accounts receivable that could grow unrealistic over time and would require an error adjusting entry at some point. Whereas the balance sheet method is going to report our bad debt expense that could prove to be fairly unrealistic if we have a large error and we automatically correct for it in a subsequent period, which of course is what the balance sheet method does. All right. You understand that the financial statements are the financial statements of the company of management, and it's management that prepares these. We recognize that there is probably an acceptable range of estimates based on your experience and based on the experience in your industry. We also know that this is an estimate, and so we don't expect that it's going to be perfect. Errors are expected. If you don't have them, the auditor may question why. So the point is that obviously management can probably determine a reasonable range, and then management's in a position to push to the bottom or the top of that range, depending on what targeted earnings per share might be. Of course, auditors will test for the reasonableness. They will look at the statistics that you've used. They'll ask about them. They'll prod and poke a bit. They'll test your numbers. But so long as it falls within that range, you'll probably find that the auditor will be happy with the estimate. So how do auditors audit accounts receivable? Generally accepted auditing standards, which are very unfortunately called GAAS, require confirmation of accounts receivable with debtors. And we probably use an ABC sampling plan so that we divide our receivables into categories, and the large ones might fall in the A category, and we might confirm all of the large ones. And then the B category would be those middle-size receivables. And in here, we probably use statistical sampling techniques to determine what size the sample should be here, perhaps 27%. And the smaller accounts receivable, we may only need to confirm if our statistical sampling tools tell us we may need to only confirm 3 or 4% of those receivables to get a good idea about the likelihoods that there are problems with our numbers and with the receivables themselves. Auditors will use two kinds of confirmations. A negative confirmation would be a confirmation that's sent by the company to its customer, and it would say, We're in the process of being audited. Our records show that the receivable from you is X number of dollars. Would you please tell my auditors directly if that balance is wrong? On the other hand, we might use a positive confirmation. And a positive confirm would ask that customer or that client, tell me if the balance shown is right or wrong. I want to hear from you. And that's where we tend to find positive confirms used for these accounts. And for these accounts which are individually immaterial, we may use negative confirmations. The decision is the auditor's as to whether you use a negative or a positive confirmation here. So it's clear that we require confirmations as an audit test of the balance in the accounts receivable account. And if problems develop, if our confirmations are showing difficulties, that may be an indication that a great deal more auditing work needs to be done and that there may be errors, and those errors may be material. And so the auditor will prod and push until some level of comfort is reached or until the numbers that we've shown on the balance sheet for accounts receivable are changed. Okay. Accounts receivable, defined pretty simply, and then a lot of attention paid not to the receivables, but to the unreceivable receivables represented in the bad debt balances. It's an interesting area to study and a challenging area to audit and to develop those estimates that management must develop. All right. If there are questions or issues, let me know. I look forward to hearing from you.